Hey guys, this is Dami Solari, your favorite YouTuber, and you're watching DS Atlantic Finance. Whoa, Bawoni, Kujometa, Mommy, no, Daddy, go. You're probably thinking, what is he saying? Well, truth be told, I was speaking in Yoruba just then. I'm from Nigeria. Now, the point I'm trying to raise is you have so many languages across the world, but you also have the financial language. And for any investor to be successful in the stock market, you need to understand the financial language. So what I'm going to go through in this video is two key terms that if you want to be a successful investor, you need to know the implications, you need to know the meanings of these terms in full detail. Stay tuned, guys. You know it's coming. Now, before I get into these two financial terms, I think it's important to stress, guys, that it's not just learning these two terms that will make you successful. You need to learn everything. You need to be able to have conversations in terms of money with people. So, I don't know, if someone was talking to you about, oh, how are the dividends this week? Yeah, you'll be able to tell them, yeah, dividends went up by this much. No, actually, the percentage yield was quite low. So, you need to be able to talk about that in full detail. So understanding financial language is key to being successful in the stock industry. With that said, I'm going to go through one of the really important terms, dividends. What are dividends? Dividends is basically where you have bought a share for a company but receive a piece of the cake, as I like to put it, without having to touch the money that you initially put through. So for example, if I was to, Apple right now is placed at $146 per share. So if I wanted to invest one share in Apple, I would need to pay $146. Cool, no worries, I've paid for that. So after a year, I would receive dividends from Apple. So I would receive a piece of their cake, so a piece of their profit. It may be small, it may be, I don't know, 3% of that sort of the profit that they've made in that year, maybe 3% of my share that I've invested, but I'll still receive that profit without having to touch that $146 at all. Now, a really good thing about dividends is the sort of opportunity you can get from compound interesting. So instead of actually taking out that 3% and using it, I don't know, to buy grocery shoppings or something, how about reinvesting that back into Apple? Imagine doing that over a course of 10 years, 20 years, 30 years. The implications are major, guys. If I was you, what I'll do is just go into Google and type compound interest, and you can see for yourself the amount of implications for just reinvesting dividends. It's important to know that dividends are paid out. They generally tend to be paid out every 3 months or every 6 months, so quarterly or half yearly. Basically, that's when they tend to pay out. Not every company does dividends. It tends to be the bigger companies, the more renowned companies. Those companies tend to do pay out in dividends. It's an incentive to basically keep the shareholder interested in their stocks. But most of all, guys, in terms of dividends, what's really important is the dividend yield. Guys, the dividend yield is so important. Dividend yield is basically the dividend, so the amount of money you receive divided by the share price. So let me put this in terms of an analogy. I want to invest in company A. Cool, company A is worth roughly £100 per share. So I need to fork out £100 to company A, and in exchange for company A is giving me £30 dividend. Okay, that is wonderful, don't get me wrong, that's beautiful. But there's also company B, which is £50 per share, but it's actually paying out £20 dividend. So from first appearance, it seems like company A is actually better because you're actually getting £30. But when you think about it, if you were to buy 2 shares of company B, you would actually get £40. So in the long run, when you actually think about it carefully, company B is actually the company that you want to go for. And that's what the dividend yield is about. So the higher the dividend yield, so the higher amount of money you're utilizing for paying for shares and receiving good hefty amounts of dividends from, the better. So the higher the dividend yield, the better. With that said, guys, it's important to know that for bigger companies like your Apples, your Google doesn't do dividends, unfortunately. Your Apples, your Microsoft, your BP, those sort of companies, they tend to have slower dividends, like slower growth in terms of dividend. So they tend to range between 2 to 4% of the share price. So that's what it tends to be for the bigger companies. In terms of riskier companies, it's important to know that the dividend yield tends to be much more attractive, tends to be much higher, 8%, 10% in cases. But at the same time, even though it is that high, it's really important to know that it's that high for a reason. It's that high to as an incentive to get you to invest in that stock. My second term is P ratio. Now you're probably asking yourself, what is P ratio? Well, it's the ratio of the price per share divided by the earnings per share. Now you're probably asking yourself, what is earnings per share? Earnings per share is the net income minus preferred stocks divided by, all of it divided by the share. Preferred stocks are stocks in which investors have invested in, and because they're labelled preferred, they automatically get paid first. So for example, if a company was in dire situation where they're actually losing money, the people who will have preferred stocks would get paid before the rest of the normal stock shareholders have been paid. Yeah, so that's basically what preferred stocks are. Now, when you have net income, it's basically all the profit that the company has made divided by earnings per share. So it's kind of flipped the other way around. So what I mean by that is you don't want a high P ratio. P ratio of 50 is awful, guys. It's not worthwhile because you're not utilizing your money that you're investing in, basically. So for sort of 30 to 40% growth companies, so companies that have improved by 30 to 40% in terms of revenue, that have increased by that much yearly, you may be more acceptable to a sort of P ratio of 25 to 30. But for a standard company, ratio of 17 or less is good. Yeah, so that's what you want to aim for. And another real good thing about PE ratio is the fact that you can use it to judge whether a company is actually undervalued or overvalued. So you can dictate whether the company is worthwhile investing in, because you know it's going to increase in terms of the share price later on. So that's why it's really important. But the way that you do that is by looking at the company that you want to invest in and comparing it to its competitors. If the P ratio is much higher for that company compared to the rest of its competitors, so say the P ratio was 20 and the rest of its competitors maximum were like 10, then you know that company is not a true reflection of its market. So you know that company is probably overvalued, because the fact that it's not a true reflection of its market. Whereas if it was the other way around, if you had a company that you wanted to invest in that only had a P ratio of 5, for example, and then you had the rest of its market was at 10, then you know that company is undervalued, because you know that company is soon going to meet its competitors' sort of P ratios. So that's why it's really good to sort of understand the implication of P ratio as well. What's really impactful is when you use these two terms together. So by these two terms, I mean dividend and EPS. So you've got the EPS that's telling you it's your sort of mecca, your sort of heaven in terms of dividends, because that's the maximum dividend you can get from just profit from the company. And then you've got your dividend and payment, which is what you're actually getting. So if you've got a company where they're paying the dividend that's actually higher than your EPS, then you've got to really look into that company, because something is wrong there. It means that they're willing to scrap all their profits for that year to pay you guys. It may seem like a good thing from your perspective, but there probably are some underlying issues in that company because of the fact that they're paying you more than what they're actually getting from profit. So you've got to really look into that. It's not a complete rule out in the sense of that means it's a bad company. No, it just means you've just got to really find out what is the cause, and if that's just a one-off, for example. Ideally, you want the EPS to be much higher than the dividend, because of the fact that you will always have that room for increasing your dividend. You don't want to pass it, because then it just means the company may not be in a good situation, and they may be using high dividends to actually entice you into buying their stocks more, because they need that investment to improve, to turn around their financial situation. So you've really got to be careful in terms of what is that actual company trying to make me do, what are the implications of its dividends actually being higher than its EPS. So yeah, it's really important to know that your EPS needs to be reasonably higher than your dividends. Right now, as we speak, Apple has an EPS that's roughly 4 times its dividends, and that's considered good because it means that there's more room for the dividends to increase. Ideally, what you want is your EPS to increase as your dividends increases. So you don't want the company EPS, you want it to increase, because that means the company is making more profit. It's making more profit. The profits constantly increase from year to year, and while that's increasing, you want your dividends to be increasing. It's not just about those 2 terms, it's about knowing everything in general. It's about learning the financial language. Those 2 terms are key, yes, but without the good foundation being laid, you can't expect to build upon it. And that's the end of my video for this week, guys. For this week, you know it's coming next week, but yeah, if you really enjoyed this video, or you feel like you've got actually 2 different key terms other than mine, or maybe one key term that's mine and the other might be a different one, then please comment down below, guys. Let me know, fill us in, let's get this sort of group chat going. But yeah, other than that, if you like my video, you know what to do. LSS, like, subscribe and share. DS Learning Finance. Whoa.